This is Commodity Wrap. I'm Tony St. James. Our segment today is Brian Hoops, president of Midwest Market Solutions, joining us. And Brian and I have a chance to talk during Market Day Report on RFD TV, Monday, Wednesday, Thursday, and Friday. And seems like each day is a little different. Some days, there was a little stretch there back in March where I think we were starting to wonder if it was Groundhog Day because every day seemed like kind of boring trade. But since then, things have really picked up. I guess it was that end of March acreage numbers that kind of finally opened the door. Flash sale in the overnight to unknown destinations for corn. Was that enough to just turn the market around because we've been lower for 3 sessions coming into today?
I think it was that was part of it. I think that was a combination of the fact that we did have that export sale 2 out of the last 3 days, plus a strong EIA number this morning that helped strengthen up a little bit and hold the gains that we had put in earlier in the morning, and the fact that wheat was able to finally bounce a little bit. Instead of falling to fresh contract lows, we were able to actually move a little bit higher off of the lows, and that helped corn. I think corn really wants to try and rally, but wheat seems just like an anchor around it and just cannot get any traction or any footing with the wheat plunging to fresh contract lows all the time.
Why is it that wheat is struggling at this point? Is it geopolitical? Are we too expensive? What's happening?
You know, you would think with the dollar coming down like it has, prices would improve. Our demand would improve. In fact, inspections were very strong this week. But I think that may be more of a function of the market trying to ship some product before the end of this marketing year, and not so much just the fact that we have a new marketing year coming. So our shipments are improving, but we just have so much wheat supplies around the U.S., around the world, and it looks like we're growing another crop of wheat, even though acres are down just a little bit from a year ago. We're getting very timely rains, and this wheat crop should really be flourishing with those rains. I would look for crop condition ratings to gain another 2 to 3% on Monday, given the rains that we're going to have this week and weekend across the winter wheat plains areas. It's going to put more supply pressure on this wheat. Of course, that kind of translates to supply pressure against the corn crop as well.
Brian, we get an export sales report out on Thursday morning before we start the day session. I already know corn will have 240,000 metric tons sold at least, or at least I'm guessing. We've had these flash sales going. We had a flash sale earlier in the week for soybeans. And normally, if it says unknown, we'd think that's China, but there's no way China's in the market for U.S. beans, is there?
It's very unlikely. They're buying a lot of product out of South America, particularly Brazil. The month of March saw record exports for Brazil to China, so it's really unlikely that China is buying anything, especially with the tariffs being involved. They don't want to even give the appearance that they want to buy from the United States now. They want to give the appearance that they do not need the United States, that they do not need to buy any products, and that is a true statement until we get into August, September timeframe when they run out of South American beans to source. So they're going to need U.S. product at some point, but they don't need it between now and very late summer.
Okay. Our outside markets here, and we've talked about what happens on Wall Street and how it can have a tie over to the markets. Got some negative news out to start the morning on some jobs and the economy, and really the equities had a hard time recovering from that. What kind of pressure does that put on commodities?
So, yeah, we talked earlier this morning on the TV segment about that ADP number and the GDP number data that came out. It's going to put pressure, especially against the cattle complex. We talked this morning quite a while about cattle possibly topping out in here off of this news, because the market's always looking ahead and looking at the news, and it's not good for the U.S. economy or the U.S. consumer. So what we're talking about is ADP employment change. It was only 62,000. That's the smallest increase in private business jobs since July of last year. And our GDP number, our data came in at negative 0.3%. Trade was looking for a positive 0.3%, well below expectations, and that pushed the odds of a recession to a new high of 74%. So there's a very high odds we could see a recession sometime this year. And of course, consumers during a recession will pull back on their spending any way they know how, trying to save money. And that means they'll cut out a lot of the things that they deem non-essential. So it could mean bad news for places like Starbucks that have expensive coffees, high-end restaurants with expensive beef prices, and even consumers at the retail level may want to substitute different proteins sources for beef, because beef is more expensive than poultry, more expensive than pork at this time by a long ways.
You mentioned beef and pork, so let's take a break. We'll come back and look at those proteins. Brian Hoops is with Midwest Market Solutions. He's back for the next segment of Commodity Wrap. This is Commodity Wrap. I'm Tony St. James. On a Wednesday, final trading day of April. Hard to believe May is here. And not only is May here, we'll also get USDA World Ag Supply Demand Estimates. That's coming out in, I think, less than 2 weeks. It's right around the corner. It won't be long before we get another cattle on feed report, and probably won't be too long before we're getting a quarterly hogs and pigs report. Getting ahead of myself here, but I can tell you the market settled in the red on Wednesday. Thought maybe we'd see a bump higher based on cash prices, but live, feeder cattle, and hogs all in the red. Any thoughts here?
Going back to our little discussion about the economy and the recession possibilities, if in fact that does happen, it would mean beef demand would start to slow. And that's really the chink in this cattle market's armor, is what happens at these high price levels if consumers back away from demand here, because our supply numbers are not going to change anytime soon. They're going to be what they are. Concern is if we would lose demand, if we would lose export business, what does that do to our pricing structure? And we may soon find out if, in fact, the consumer starts to pull back at these higher price levels and a recession starts to hit. If consumers feel the pinch in their pocketbooks, despite energy prices moving lower, if beef prices stay high, pork prices are much cheaper, there's going to be an alternative for the consumer, and they may make that choice. Now, we hope that grilling season is right around the corner for most people. You have Mother's Day, you have Father's Day, and Memorial Day coming up here all soon. That those are prime grilling opportunities. That demand at least would remain strong for the near term, but it's something I think producers would really have to take advantage of, is at least buy some put options going out into August, October timeframe and get a minimum price floor established.
Looking at the hog market, back in the red on Wednesday, after settling in the red on Tuesday. We started the week in higher territory, so right now it kind of looks like we'll trade 2 sessions higher, 2 sessions lower, 2 sessions higher, 2 sessions lower. So could that maybe signal a move higher on Thursday, or is there still plenty of fundamental news here to pressure the hog market?
You don't like the fundamental news from the standpoint that we're in this trade war with China, and they have started to cancel U.S. pork exports. We're very dependent upon selling our product to China, and without them as a consumer, number one buyer, our prices are way overvalued at this $100 level. So I think we can pull this market back significantly going into the spring until we reach some sort of agreement with China to buy our product. Now, we've talked before that they can go a long time without buying any U.S. soybeans. They're going to need to buy pork products from somebody. Hopefully that's the United States. I think they want to buy product from the United States before other countries. that's going to be the key, is when we can get an agreement on pork reached, that they will continue to buy U.S. products before markets really start to push lower. But I'm afraid we're going to start trading lower in here going forward, fearful about what is happening with overall pork demand.
Demand and some other fundamental news kind of working its way into the energy market. West Texas Intermediate lower, RBOB lower, and that gas was moving higher, but on that crude, we're back below $60. What happens now?
Yeah, from a seasonal standpoint, usually we should see appreciation in prices as demand improves, and we've seen a little bit of demand improvement. The problem has been not much export business to China because of the tariffs. China's a huge buyer of U.S. Oil products. OPEC is talking about increasing their production numbers once again, kind of to compensate maybe to try to sell more product into China and Asian countries the U.S. is in a trade war with. So they're wanting to increase production. If we increase production, the U.S. is running at large capacity already, producing the most we ever have. We're going to supply the world with a lot of product, and that's why we're seeing prices drop sharply in the last 6 or 7 trading sessions from the mid-60s back into the 58 range. And I'm just afraid that we're going to continue to put pressure against our crude oil prices going forward. The administration wants cheaper energy prices, and it's a fact that should help bring down prices overall for the consumers if we can bring our transportation costs down. So that's what they want, and I think that's what the market is trying to factor in. And I don't know that we're quite ready to say there's any type of a seasonal low in at this point.
All right, Brian, contact information. Where can we find you?
Yeah, we can talk about markets. You can give me a call directly, 417-501-5132, or you can go online, find a list of our offices around the Midwest, MarketSolutions.com.
Brian Hoops, President, Midwest Market Solutions. This is Commodity Wrap.